Today we're talking Tesla. Price is sitting at $406 right now, May 18th, 2026, and I'm going to walk you through everything, why it dropped, why I think it's about to move, and exactly how I'm planning to play it with options. But before we get into all of that, I want to take a second to welcome someone special to the channel. Simo just joined us as our new pro analyst, and he's going to be bringing his fundamental analysis expertise right here. So if you want deeper dives into earnings, valuations, macro, Simo's got you. Welcome to the team, man. Glad to have you. Now let's get into it. For years, if you believed in Elon Musk's vision, Tesla was basically your only option as a retail investor. That's starting to change. Other vehicles in the Musk ecosystem are becoming more accessible to regular investors. And if capital that used to flow into Tesla can now go elsewhere, that's a real headwind for the stock. And that's actually one of the reasons we saw this recent sell-off. So let me break down everything that happened fundamentally before we look at the chart. The first thing that rattled investors was insider selling. Tesla's CFO, Vaibhav Taneja, sold a significant amount of shares recently. Now look, insiders sell for all kinds of personal reasons. It doesn't automatically mean something's wrong. But when it happens in an already nervous market, people start asking questions. Is the guy who knows the books better than anyone quietly heading for the exit? That kind of sentiment spreads fast. And on top of that, there are real concerns about valuation. Tesla trades at a massive premium compared to its intrinsic value by most traditional metrics. The market is essentially pricing in a perfect execution of every single promise Tesla has ever made. Full self-driving at scale, robo-taxis everywhere, AI domination, and when reality starts to lag behind that narrative, the correction can be brutal. Speaking of robo-taxis, this is huge. The recent pilot programs in several cities run into some pretty serious operational issues. Long wait times, navigation problems, software glitches. And this matters enormously because Tesla's sky-high valuation isn't built on selling cars. It's built on the promise of autonomous transportation at global scale. If that story starts to crack, the whole thesis gets questioned. Then you've got regulatory pressure. Authorities are actively investigating Tesla's autonomous driving system following several incidents. There was also a major vehicle recall over rear camera issues. For a company that's telling you their cars will drive themselves safely, a camera recall is not a great look. On the financial side, the picture is mixed. Earnings actually came in slightly above expectations. That's positive, but revenue missed. And there are signs of inventory buildup, meaning cars are being produced faster than they're being sold. Analysts have been trimming their estimates for the full year, and capex projections for 2026 are heading higher, which puts pressure on near-term profitability. So when you put all of this together, insider selling, valuation concerns, robo-taxi disappointments, regulatory issues, mixed financials, and now new competition for investor capital within the Musk ecosystem, you get a very logical reason for the sell-off. This wasn't panic, this was the market repricing risk. And that repricing is exactly what brought us back to where we are now, right on the trend line. Now look at the chart, because this is where it gets interesting. Tesla is one of those rare stocks that actually respects its technical analysis. I know that sounds almost too good to be true, but look at what happened over the past year. We had a clean ascending trend line connecting all the higher lows from the bottom around $330. And every single time the price came back to touch that trend line, it bounced hard. People who bought at the trend line, whether they were buying shares outright or using options, made serious money each time because the bounces were sharp, fast, and they pushed all the way up to the resistance levels. Buy the trend line, sell the resistance, that's the play. And Tesla keeps giving it to us. Right now the price is at $406. And if you look at the chart, we are sitting right on that trend line again. Same setup as before, same zone, and the resistance target, that's sitting at $470 to $473. That's about 16% upside from here. The setup is clean, the risk is defined. This is the part one, no, a lot of you have been waiting for. And before I get into the specific trades, let me just quickly explain how options work for anyone who's newer to this, because it's important to understand what you're actually doing. An option is a contract that gives you the right, not the obligation, to buy a stock at a specific price before a specific date. You pay a premium upfront for that right. That premium is your maximum loss. No matter what happens, you cannot lose more than what you paid. One contract always represents 100 shares. So if an option costs $12, you're paying 12 times 100. That's $1,200 per contract. Got it? Good. Now let's talk about the two strategies I'm looking at. The first one is the long call. This is the simplest, most straightforward way to play a bullish move with options. Here's the exact trade. You buy a call option with a strike at $410, expiring in roughly 45 to 60 days from now. Why 45 to 60 days? Because you need to give this trade time to breathe. Options lose value every single day. It's called theta decay. If Tesla takes 3 weeks to bounce and your option expires in 2 weeks, you're dead, even if you were right on direction. So we take enough time. The premium on this option is around $12 per share, which means the total cost for one contract is $1,200. That's your maximum loss. That number is locked in the moment you buy. Tesla could go to zero. You still can't lose more than $1,200. Your break-even is $422. That's your strike of $410 plus the $12 premium. Tesla needs to be above 422 at expiration for this trade to be profitable. From 406, that's only a 4% move. For Tesla, that's basically noise. Now the scenarios: if Tesla drops or stays flat below 410, you lose your 1,200. That's the worst case. If Tesla bounces back to 430, you're above your break even, you're making money, roughly $800 profit. If Tesla hits our target at 470, this is where it gets exciting. You're looking at around $4,800 profit on a $1,200 investment. That's a 400% return. And here's the beautiful part. If Tesla blows past 473 and keeps going to 500, 520 higher, your profits are unlimited. There is no ceiling. Every dollar Tesla goes up above your break-even is money in your pocket. That's the long call. Simple, powerful, unlimited upside. The cost is higher entry, and you need a meaningful move to really shine. Now, the second strategy, and this one is a little more sophisticated, but hear me out, because once you understand the logic, it's actually very elegant. It's called the bull-call spread. Here's the thing with the long call. Part of what you're paying for in that $12 premium is the possibility that Tesla goes way, way beyond $473. The optionality costs money. But what if your thesis is specifically that Tesla goes to 470 and stops there because that's a strong resistance zone? You're paying for something you don't even need. The bull call spread lets you say, I believe in the move, but I know where it's going to stop. And in exchange for capping your upside, the market gives you back money upfront. You pay less to get in. Here's exactly how you structure it. You buy the call at $410, same as before. And at the same time, you sell a call at $470. That call you're selling brings in around $4 of premium. So your net cost is 12 minus 4, that's $8 per share, or $800 per contract. $400 less than the long call. That's real money. Your break even is now $418. From 406, that's just a 3% move, even easier to reach. Now the scenarios. If Tesla drops below 410, you lose $800, not $1,200. Already better. If Tesla climbs to 430, you're profitable, making around $1,200 on an $800 investment. That's already 150%. If Tesla hits 470, our exact target, you capture the maximum profit. The spread between your two strikes is $60, minus the $8 net premium gives you $52 per share. Times 100, that's $5,200. On $800 invested, a 6.5x return. Compare that to the long call at the same target, 4,800 on 1,200. The spread wins on every scenario between 410 and 473. The only scenario where the long call wins is if Tesla keeps going well past 473, because then the spread is capped and the long call keeps printing. One thing I want to make sure you understand about the spread, when you sell that 470 call, you don't need extra capital or margin for it. The two legs offset each other perfectly. Above 470, your short call loses money, but your long call gains exactly as much. They cancel out. That's why your profit is capped, but your risk never grows beyond your initial $800 investment. Two more things before I make my decision. First, you don't have to hold until expiration. If Tesla rips to 460 in 2 weeks and your position is up 70% at maximum profit, close it, take the money. A lot of experienced options traders close spreads at 50 to 70% at max profit rather than waiting until expiration. Less risk, cleaner exits. Second, implied volatility matters. The premiums I'm quoting are estimates. The real premiums you'll see depend on Tesla's implied volatility at the moment you enter. Higher for means more expensive options. For the spread specifically, higher for is partially hedged. You're buying an expensive option, but you're also selling one, so the cost impact is reduced. That's another reason the spread is more robust in volatile conditions. And by the way, if you're finding this useful, smash that subscribe button right now. This is exactly the kind of content I put out every week. Real analysis, real trades, real numbers. Okay, so after laying all of this out, where do I land? I'll be honest with you, I genuinely went back and forth on this. The long call is tempting because it's simple to manage and because if Tesla surprises everyone and breaks through 473 to go after all-time highs near 490 or 500, I capture everything. But here's the thing, my thesis is specific. My analysis says Tesla bounces off the trend line, climbs to the 470 to 473 resistance zone and stalls there. Because that's what strong resistance does, because the fundamentals don't support a major breakout right now. So why am I paying for potential beyond 473 that I don't even believe in? I'm going with the bull call spread. Call bought at 410, call sold at 470, 45 to 60-day expiration, $800 at risk, $5,200 maximum profit, 6.5x the money. Perfectly calibrated to exactly what I think is going to happen. That's what good trading looks like. Not just picking a direction, picking the instrument that fits your exact thesis, your time frame, and your risk tolerance. Drop your questions in the comments. I read everything. And if you haven't subscribed yet, do it now. See you in the next one.